next session. I think we've logged like maybe 2 years of these things now, Imran. So
Yeah,
we can be very
going
good at the
strong.
craft. Maybe. A lot of interesting things going on. I usually just start firing off at the mouth about what I see going on here. I'm gonna let you start today. We got VIX expiration tomorrow. We got Friday OPEX. We got Powell speaking tomorrow. We got Tesla, Netflix earnings. We got 10-year yields back at recent highs, but equity markets are up with small caps. Where do you want to start? You fire away first.
Yeah, I mean, there's just so much thrown in, isn't there, to deal with? I mean, if we take a step back, we go back a couple of weeks, where markets were kind of carving out a little bit of an interim low. We'd seen quite a few signs of a bit of panic, with a VIX spike and skew going quite well bid and yields kind of topping out, both interest rate vol spiking, skew spiking, and rates as well. Seen a bit of panic there. And then we started to get a bounce. We started to also get the Fed talk a bit more dovishly, saying that the long end yield moves were doing some of the work for them. The market liked that, and we started rallying, and vol started to compress across all asset classes. But then we've got the Middle East tensions flare up between Israel and Palestine, and that kind of threw a spanner in the works. That brought another vol spike that I hadn't really anticipated happening, because that came out of the blue, and that's kind of now muddied the waters. And then it's like you get a momentary bid to bonds along with gold and oil as a flight to safety, but the bond bid just can't hold. So you've seen bonds almost get back towards their lows quietly, whilst oil is still firm, gold is still firm, because you've got, obviously, we don't know when this thing's going to get resolved, whether this is going to de-escalate or escalate further. Iran have been talking quite tough lately as well. So it's a tough one. And then throw in a few extra things like Tesla and Netflix earnings and what have you. It's a mess. A few couple of expiry, a couple more expiry. It is a mess. I mean, the one thing that, we did think vol was going to come down. We talked about this on Monday. We have seen the VIX come down after that bid that it caught on Friday. It did look like it was overdone. But it's hard to call an end to this episode, whatever you want to call this thing. I don't think this episode is just going to go away now directly from today. So I think you are going to see probably a few more flare-ups, and it's going to keep investors on edge. And I think until we get through the back end of October and we've seen what the tech earnings look like, that helps steers the market. I mean, I think the S&P is holding up just because people are a bit more optimistic maybe on earnings. Like the tech names always beat, and they think they're going to beat again maybe. And so people are trying to play earnings to the upside, because the S&P is shrugging off what rates are doing, because rates, like I say, yields are headed back higher, right? So it is a bit of a head scratcher at the minute.
Yep. Yeah, I think that's a very succinct overview. It's a mess is pretty much how I would characterize it as well. On the screen here is the VIX that's the candle, and then you got the 10-year yields in blue. And so to your point, the market today, equities are shrugging off those higher rates. Small caps, I think IDOM's up about 2%, and the Mag 7s are doing pretty well. I personally think that this is a little bit of a function. I think Yellen may have made a couple comments today. Added to that mix, by the way, I think 17 or 21, somewhere in there, Fed speakers over the next 2 days. Some guys are having multiple speeches. And so, you get one headline here and who knows what's going to happen. But I think because we have VIX expiration tomorrow, my view of this was VIX got overbid on Friday's close because people were hedging, escalation of the conflicts in the Middle East. And that we were due for some mean reversion there. And I think heading into OPEX, that OPEX is suppressing, VIX expiration tomorrow is, I think, suppressing vol a little bit. And that's helped to boost markets. I mean, if you look at the S&P over the last couple of days, we're just ping-ponging back and forth in a pretty tight range. Like, we're essentially going nowhere, as you can really see here. And so I think that VIX expiration tomorrow could pull out a little bit of the support of the equity market, and OPEX in general could help to remove some of that support. Now, as you said before, you got Powell and Netflix and a whole bunch of other things. So it just makes it very difficult to estimate, higher or lower. But I do think that sort of this general area of the 43.50 to 44.40 pin, I think that's going to go away. And I think the market could be more directionally reactive to some of the other things that are happening. Just to give a quick view of the VIX expiration open interest. This is as of this morning. So you see there's a lot of puts down here at 15. There's a lot of calls up there at 20. And we've really held that range in VIX right over the last couple of days, even a little bit maybe closer to that 17 to 20 range. So, this is sort of that fair value spot for the VIX. And maybe some of this expiring could also kind of unpin that volatility position as well.
Yeah, I mean, typically, these sort of geopolitical events are not. You don't get rewarded for selling stocks into these type of events. But that's not to say we're not going to get a couple more weekends of nervousness, right? So I think it's one of those, you don't want to go heavily short into it, but then you also don't want to be short a load of risk on the downside, I think, right?
Yeah.
So you got to strike that balance. So I mean, VIX at 17. If we're okay in a month and markets do rally and things calm down, VIX are going back to like 13, 14 easy. So we mentioned this in the Monday meeting, right? Is structures that get you short VIX but don't get you in trouble if the VIX goes through 20 again are probably the way to play this, right? So just and then on the upside as well, on S&P, doing like call fly, call laddery type structures that are short vol on the upside but don't get you short any vol on the downside are going to be the way to stay safe in this kind of sketchy environment, let's say.
Yeah, and you bring up an interesting point on the chart here is that Friday VIX move relative to the intraday change in the S&P. And the S&P, I think, was down 75, 80 bips on Friday from the open to the close. And this was the move in the VIX, right? Because of that Friday vol bid on the war concerns, right? And back to your point, we're gonna run into VIX expiration tomorrow, which I think could. Again, I think vol's getting suppressed. So we're going to head into Friday, and we mentioned this in the note too, that we're going to head into Friday where there's probably going to be a bid to vol, if anything, right? It's unlikely to, I think, get sold hard into Friday because of the potential geopolitical issues. Biden, I think, is going there tomorrow, and I don't know. Before they said it was the skies had to clear up. So it's kind of a mucky situation, and if anything, you would think it buoys vol a little bit. Even if equities rally, you think vol probably hangs in there a little bit, right?
Yeah, I mean, generally every Friday you do tend to see some supply of vol, but if there's a reason why people want to own it, then they'll soak that supply up fairly easily, right? And you're already taken some of the froth out of it from last week, so kind of depends where we are going into it. But I tend to agree. Like, I don't think that, going into another weekend where nothing's really cleared up. I suspect risk protection will still be quite firm, right?
Yeah. So let's just cover some of the basics and OPEX here. If you look at how big this expiration is relative to other sizes, you got October right here. This is across the S&P, NASDAQ, and Russell. And the first thing that I note here is just pretty balanced. And when I say balanced, the size of call positions is roughly equal to that of puts. And so, it's not call heavy, it's not put heavy, it's just very neutral. And it's not a massive expiration. It's a decent size, but this is December. December's obviously a monster. The quarterly expirations tend to be a lot larger. So, we got a decent amount of flow. I think this can impact maybe some special single stock situations. Could be, maybe it'll call heavy or put heavy. We can talk about some of those names shortly. But I don't see this as a really particularly large expiration. And so just this idea of unpinning into this mess that you mentioned before is kind of the way that I'm viewing this. I think people have been scratching their heads a little bit at some of the equity resiliency despite the higher rates. And again, I'll just point back to some of the volatility coming down, the VIX coming down, and also this OPEX effect, right, might be holding up the market, and maybe we start snapping back or the market sinks back with those rates.
How would you play that then? Would you what type of structure would you use to get a bit of downside exposure for the next week or two?
Yeah, the issue here is that I don't think that volatility is particularly cheap, obviously.
No.
So I don't want to be long vol. So if I was going to buy options, I would buy, higher delta puts, something that's more sensitive to the underlying movement as opposed to owning volatility or Vega. I might also just be inclined, honestly, to short spiders if I thought things were going down. I think in a lot of these situations, it can get complicated to express an idea using options because the volatility is getting so high and skew can get funny in the way that you position a trade. Again, you could be right directionally but then just be off, because you put on the wrong structure. And so I think in these situations, oftentimes you can get such a good punch in just owning equities or higher delta options is what I'd be looking to do here. And I also think that there's some pretty defined ranges here. I think 4,500 the upside out of this week, out of OPEX week would be, probably a target in the end of October. If let's say Tesla earnings are great, Netflix is great, and Powell comes off as slightly dovish, and we just sort of get a pause in the war escalations, right? Then I think that 4,500 level can come up pretty quickly. So maybe some call flies up into that strike would be kind of interesting. And then to the downside, I still look at 4,200. So I think there's a lot of movement to be had out of this, but I worry about overpaying for that volatility. At this price, that can be a pretty steep price to pay if you're long.
Mm-hmm.
What about you? You got any trades out of here that you'd?
I mean, like when the vol's off its highs, but it's still not cheap. It's mid range, let's call it, and then the skew is quite pumped, I would say. So then like put spreads are probably the only sort of safe way to get downside exposure. You could do like put ladder, put ratio, put flies, but they're going to be either too risky because you're selling the downside tail, or they're not going to be monetizable because you need to go down and then stay there, which is not likely, right? What's likely is you go down and then you blink and you miss the bounce. Right. So I think some sort of put spread is probably going to be the better expression. So maybe a super short dated 1 to 2 week expiry, something. You look at where the levels are, wherever levels of support that we just carved out in the latest little drop. Maybe you pick a long strike somewhere near there. So where did we get down to? 43, just above 43. So maybe you use 43 as your long strike, something like 42 as your short strike.
Mm-hmm.
You think that's kind of the target area on the downside. Probably get some half decent leverage on a 43, 4,200 put spread. Yeah.
Yeah, and to the point on volatility, one of the things that, as we're just thinking about it here, I think there's a lot of single stock names that are getting sold off pretty hard that you're not seeing a relative vol move. And so, I could bring up a couple of these, and maybe they're interesting for some type of a beta trade, even though you could argue that the beta hasn't really been working too well. But some of these names, particularly, we were kind of joking around the other day, calling them the Ozempic kind of cast off, and maybe there's some other issues here in terms of I think higher wages and things are hitting McDonald's. But a lot of these names that you could argue are the reverse Ozempic trade are getting just pounded. And what's interesting is when you look at the volatility of a lot of these, the vol's not really necessarily getting bid up. And so I actually think that these could be interesting long plays because they've been just so battered, and I don't think that vol is really that high. So these could be some interesting ways maybe to express a rally or play a little bit of mean reversion. It's hard because the Magnificent Seven just continue to be such a source of strength for stocks, but some of these things are now getting so beat up that if you are looking for just upside kind of beta, they might be a little bit interesting. Do you have any views on some of these names that maybe they're not too options heavy, but they are?
These are like the Dow. These are like the Dow names, basically, right?
They are a lot of the Dow names. I would.
Yeah. I mean, they've been so out of favor, haven't they, for a while? So it shows that there's definitely some sort of rotation going on out of these and into the more techie stuff. I haven't got a strong opinion on them, to be honest. Or actually, I haven't really played in them or done much with them. But yeah, I would probably wait for them to turn and show some strength, because once they show some strength, then it's like they've got quite a long way to catch up to where they were.
Mm-hmm.
So that's like your green light. And then because the vol's not expensive, once they start to rally, you won't be paying up for the vol. The vol will be getting even cheaper. So you'll be able to then buy upside calls at a really quite handsome, cheap vol that you'll then be able to participate in further upside. So that's kind of how I would probably think about it on those down names.
Yeah, great insights there, and I do think some of these names are, again, I don't do fundamental research here, but some of those names are, I forget what the donut stock is. I was looking at, I was kind of laughing about. I'll have to find it later. It's on another chart there. But Dollar Generals, these kinds of names are really just getting beat up. And I was laughing today because people are talking about how strong the small cap rally was, and this market's now being led by small caps. I think it's way too early to say that in terms of also, looking for something to really move. They're doing great today. And the reason I bring this up is because I think what everybody would like to see to kind of have more faith in a bull market or a stronger finish in the Q4 is just better breadth, right? I mean, we love to see the small caps get involved with the rally and some of these other names kind of pick back up. Right now, it feels like it's kind of the opposite. The Magnificent Seven is what's pulling everything higher. And the options flow in those Mag 7s are just so strong that I think that's doing a lot of, kind of this heavy lifting. You got anything here on the small caps? I haven't actually checked implied vols here.
Yeah, no, I mean they've been dogs. They have not been. I mean, you've had obviously the regional banks play a reasonable part in what the small caps do as well. There's quite a strong correlation between how the Russell's trading and how the regional banks are trading. So regional banks were heavy, but they've had quite a nice snapback in order of magnitude 5% in the last 2 days, right?
And bank earnings have been pretty good. Both the large cap and then I think Schwab put up a pretty good number. As you can see, there's a decent little bounce here.
Yeah, so I mean, I'm still not convinced that the regional banks are out of trouble. So I think any bounce in the regional banks is probably just a dead cat bounce, and they have got a lot lower to go. But you might need to be patient and wait until sort of next year for that sort of thing to really play out on the downside. So it's a hard one to call. But yeah, Russell, I agree with you. Russell is not leading the market, right? I mean, it's having a snapback rally from quite beaten up levels, but the leadership hasn't been coming from Russell. That's been underperforming for quite a while.
Yeah. Maybe we start a trend today, but it's a little too early to call that. Wavy McFly, Martin, Bob Tag, Rajinder. Hope I pronounced your name, sir. If I mispronounced it, apologies for that. Good to see all you guys. Mr. Perfect 2 asked about Google puts. Are they any good? What do you think about the idea of, in general, fading strength? If I was going to try to short something, I don't think I would go with the Mag 7s. I think I would go with some more of the peripheral kind of stuff because these names have been strong, and I think in sell-offs they tend to not perform. They overperform during weaker markets at the moment, and I just think that if you want to sell stuff that's more likely to get weak, right, and more likely to be hit by the story of higher rates or whatever it may be. So I would rather personally be something short, something maybe more in the ARC realm as opposed to something of the leadership realm. Any thoughts on that?
I totally agree with that. I just don't. It's such a strong stock. It's probably one of the strongest out of all of the Magnificent Seven. And yeah, I mean, you can tactically think it's kind of done enough on the upside, and it's showing. If it ekes out a little new high, where is it right now? 139 and a bit. If it ekes out a new high at like 142 and it does it on lower momentum, you've got a momentum divergence, and that could be a short-term tactical bearish signal. But like it's not. It's in an uptrend, right? Like, and this name is just a cash machine. So if you're going to go for that type of trade, generally I favor it more tactical, very short term, trying to play a bit of mean reversion and then get the hell out quickly. But yeah, I wouldn't fight the trend in names like Google, to be honest. I don't see the point.
Yeah, that sinks a lot with what I think as well. I want to bring up two other names and dive in these a little bit more. I'm not a rates trader, so take this with a grain of salt. TLT, the longer term ETF, is right around this 85 level. And what's interesting from this level, obviously, this is the long term U.S. bond ETF. It's been getting just curmudgeoned. Is that the right word? I don't know if that's the right word. It's a curmudgeon. What I thought was interesting about this, when I was looking at some of the positioning in TLT, what you see is, and I'd love to get your take on this, is that the put positions, really any of the positions down below 85 in this name, and put positions show up as blue, calls here in orange, they don't exist. It's sort of like the options market is totally uninterested in positioning down at strikes lower than 85, which to me almost suggests a little bit of possibly a bottom, or that the options market thinks there could be a bottom. You also have record call open interest or record call volumes, I should say, in TLT. And yes, the put volumes are elevated too, but call volumes are a level or magnitude above that. The other similar thing is in XLU, where you can see here XLU's rallied. There is a bit of interest here at 50, but overall, it doesn't seem like the options market is really wanting to bet on, a whole lot more downside, and some of these things that are really kind of stretched. I mean, XLU obviously quite a bounce back here. And I hate putting you in the position of having to say, hey, what about longer term rates? But what about this idea of looking at the options market as a sentiment tool or a way to sort of gauge positioning? Let me also preface this that I don't think there's any chance in heck that hedging flows from TLT move long bonds. I don't think that's the case at all. I think it's interesting from a sentiment perspective in this case.
Yeah, so it was about a week or two ago that we saw a bit of a super spike in that TLT vol, like the highest, because I track that as one of the assets that I track in all my cross asset dashboard, right? So I saw that vol in the front end go to 25, which is as high as I've seen it in ages, right? It was like in the 90 something percentile. And the skew went to like 3 vols for puts, which is a very, very hefty put premium, right? Like historically, bond skew has always been for calls because bonds have got that flight to safety bid, or they used to have before we went into an inflationary world, right? So that skew has a bit of memory, and it took a while for that skew to flip towards puts, and then it's stretched all the way to 3 vols for puts in the front end. So that felt very stretched, right? It was in the 98th percentile on a 2-year horizon. Vol was extremely high,
and that's kind of in this zone here, right?
Yeah, that was when we went down there to 84 the first time round. So that felt very capitulatory, if that's a word. Yeah, yeah, and so I did get tactically more bullish on bonds there, but the price action is pretty shocking. Like the fact that we faded all the way back down. Now the vol hasn't quite caught as much of a bid this time, because when you revisit the level for a second time, the vol tends to not be quite as high. But we'll see, right? If this 84 level doesn't hold and we accelerate down to 80, then that bond vol has the potential to go again, right? It's just that the move on the geopolitical tensions has reminded everyone that bonds have got a safe haven quality to them in a world of, oh my God, there's a war kicking off, right? So, and then everyone's views about inflation and stuff kind of go on the back burner a bit. So whereas I thought we were going to get a bouncing TLT and the vol would get crushed, the vol didn't. It held up really well. And I just think that that's because this war dynamic. So if the war dynamic dies down and then we get a bounce in bonds because the Fed is done hiking and inflation is under control, then you're going to get a rally in TLT and vols are going to get crushed, right? But they're not letting vol get crushed right now because it's just there's too much uncertainty around what's going on with the Middle East now. And also the fact that bonds are trading really heavy because yields just keep flying, right? So it's too uncertain for them to let that vol deflate right now in TLT. So I don't know how much signal there is in terms of spot, because, I would have expected TLT to hold better than it has. And the way it's crumbled in the last 2 days has kind of surprised me a bit.
Yeah. I take all of your points. I think it's a valid view. I think that what struck me here is this is on end of day data, so sometimes the bid and ask can be a little bit wide, which can skew these vols here a little bit. But this is 1 month realized vol on a rolling basis, and here's the implied vol. And I think what's interesting to me is that because this has fallen so violently over the last 2 months, right, that it actually gives the appearance that implied vol it maybe is a little bit low here, I think, on kind of a 1 month basis, which I think is kind of interesting. But I think a lot of that is set up to express to the upside, right? Like I think people are in calls here thinking that they don't want to miss that rally and that upside convexity here, and maybe that's causing.
Speaking of that, the CTA positioning apparently is such that if yields do go down and bonds rally, then these guys might need to chase bonds higher because apparently they're quite short, right?
Yeah. So it's definitely quite an interesting dynamic. In our Monday morning meeting, we were talking about possibly doing like a buy right or something along those lines. But I do think vols come down a little bit over the last couple of days. Something to kind of consider if that TLT vol does kind of pop. We're getting some other questions in here on some of the Mag 7s and then some of the home builders. So let's take a quick look. I haven't looked at home builders recently. Into options expiration here, and that chart actually initially looks pretty good, doesn't it? Specifically, the question is, what do we think about shorting home builder stocks, Lennar, DHI, etc.? I don't have a huge view on this. Imran, you got anything on home builders in general? You look at those?
They were kind of defying all the logic, weren't they? It was like everyone wanted to short them on that massive run since earlier this year, because it's like, mortgage rates are here, home sales are falling off a cliff, and so you want to be short these, but they just kept rallying. Now finally they've come in, but it's maybe that last gasp higher in long end yields and the steepening of the curve is what's kind of spooked them. So I think it's probably a play on that, right? So it's kind of like, if you think long end yields go a lot higher, then maybe they're short, but like from this level, it doesn't feel like the greatest entry.
Yeah, I would agree with you on that. I think there's probably some other juicier things going on, and I'm not too sure. What's one of the themes that you kind of pick up on here is that it feels a lot like 2022, where when things are selling off, vol just isn't really responding, and I think that is really reflective of higher rates are just leading people to just sell stock and not necessarily worry about hedging it. Maybe they're also just shorting stock. I don't know, but the vols are really kind of unresponsive to a lot of moves lower, and it's such an interesting dynamic and one I think we're not used to. Here's a quick look at implied vol versus realized again for DH Horton, and I don't think they're particularly elevated, and I don't know if earnings wise they got anything coming up on those names. I'll just bring up some of the 2 weeks earnings quickly. So there's some of the earnings over the next couple of weeks. Obviously, we have Netflix and Tesla on Thursday. Those are the big ones. And then next week, Amazon, Google picking up on the 25th. So those are some of the upcoming earnings. On the topic of, and Nick Sodas tells us it's bludgeoned, not curmudgeoned. Thank you for sorting us out on that one. What about these Mag 7s? The case that I tried to make, and I think it's MGC or MCG is the ticker that I've been looking at. It's MGC. There it is. The Vanguard Mega Cap, which I believe is an equally weighted Magnificent 7 index. I actually have seen call implied vols or implied vols at upside strikes come in as these names have kind of rebounded recently. And to me, that indicates a little bit of selling into strength or a little bit of the bounce here. My guess-based interpretation here is that a lot of this now is going to be earnings dependent. If we get good earnings out of here, then maybe we take another shot back at those July highs. And I almost think that may be all that it is. I mean, unless rates go kind of materially higher and the whole market goes, drag down again. I think staying long these names is probably the right view, maybe over the longer term. And a lot of it just feels like it is earnings dependent, right? So, we sit here at kind of up against these call walls, like the call implied vols have come down. But I still think that these names will continue to outperform the upside, because I don't see what the reason would be if the market continues to rally. Why wouldn't these continue to lead? You have a Magnificent 7 kind of view here.
Just looking at that chart, I mean, that looks like a corrective move, right? The kind of ABC correction from August high to recent low.
And very charts have this wedge kind of view to them, right? Like you see these charts flying around like that, right?
For those who like Elliott Wave or whatever, that feels like the move from March, April up to August, the rally was so impulsive with so little pullbacks that is your textbook third wave of some kind. Okay. And then after a third wave, you typically see a fourth wave, which is a corrective wave that has an ABC formation, which is exactly what we've had since then into that low that we made a couple of weeks ago. And now we're rallying again. So just from a pure textbook Elliott Wave, that is an uptrend that is about to resume, right? Or has resumed, right? So there's no reason from a technical perspective for me to get bearish looking at that. Now, a break above like 160 on this thing is going to confirm we're off to the races, right? But just now, I mean, it is smelling like that correction is kind of over, right? So, You know, that's what it looks like to me, just from the naked eye kind of thing.
Yeah, and it you just kind of get the feeling like that the next leg is brewing, don't you? When you look at a lot of these charts.
Yeah.
Yeah, and another question here on HYG. It's down while the market is up. I mean, HYG is
Yeah.
going to be a function of rates. Rates are higher. Equities
Yeah,
at the
it's
moment
all
just don't
rates,
feel.
right? I mean, HYG, I think, has got a duration of like 7 years or something, right? So the 5 year, the belly of the curve is moving 15 basis points, which is the biggest mover on the whole US yield
Yeah,
curve.
look at that.
So I think it's just the rates move is that big, right? It kind of outdoes any risk on that we're getting from the likes of equities. The rates moves too big.
Yeah, yeah, and pretty resilient stocks again in the face of those equity moves today, which I think is a head scratcher for a lot of people. And if that kind of snaps back tomorrow after the VIX expiration, then I think that can explain a fair amount. As per usual, as soon as we start talking, markets tend to sort of shift. They seem like so. I think we're down about 20 something handles now since we started.
Really?
We have that effect on markets.
That's so funny.
Or general things in general. All right, let me check off my old list here. Anyone who has any questions, please put in the chat. We are watching, and then towards the end, we also generally like to break down a couple of different options concepts as part of our course called the Hedge, which you can visit at academy.spotgamma.com. So please don't forget about that. I don't know what the news is. I'm just checking to see if there's anything. I think a lot of this tends to be just the offset of what we've seen lately is whatever the move is into noon, it tends to kind of unwind or at least stick, right? That's been a real theme lately. It's you get these L patterns, right? Like you can see them here. Midday we change tone, right? Midday we kind of change tone, even though it's flat. We don't get that directional fall through. I think there's a zero DTE component of this. It also seems to have something to do with when Europe tends to close. Also seems to matter. I got a couple of questions on Hero. So Imran, if you'll kind of indulge me here, we'll look at some of the midday options flows. This is the S&P 500 signal, and what you can see is right around 12:30, the options market just started to sell off. And when I say that, you see this purple line come down, which tells me that people are selling calls or buying puts. And what I think is most interesting too here is that the S&P 500, this is the flow across S&P, SPX, SPY in the E-minis. It was pretty mild rally in the face of markets higher. What I did find interesting, and we just added this indicator, the Mag 7 indicator, because we want to track Magnificent 7 like anything else. Even though these stocks rallied so sharply today, and this is plotted against the QQQ, you can see the flow is very negative, almost to the tune of $750 million down. So this is the combined flow of all these stocks up here, Apple, Amazon, et cetera. So even though we get this equity market rally, the options market really is just fading it, right? And so really what happens is, in my view, you can put these kind of pieces together, right? We know that vol's coming off today with the VIX expiration and just in general that kind of trend. If you look at our one-day implied move for today, it's I think 70 something basis points like that. So that move puts you right in here based on the open to the close, right in this 43.75 area. And so what you see here, I think, is this overextension, and every time we get overextended to the upside or the downside, it seems like that just kind of reverts, and then we just stall out for the rest of the day, right? That's just been this theme. And what I think is so interesting about that is that in this situation here, if you get a 75, 80 basis point move a day, that's like a 12.5%, realized volatility. Yet we continue to have the VIX up here at, 17, 18, 19. At some point, the market movement's got to start earning that volatility, right? And if we don't, I do think you could, kind of to your point earlier, get the kind of VIX collapse, which could really help bolster markets higher. So any kind of a pause in rates, any kind of de-escalation in that conflict overseas, I think could quickly have a pretty decent impact here.
Yeah, I echoed that, and that's why someone's asking me, if you smell the end of the correction, how would you potentially front run an options play to the upside? So
great question.
My bullish expressions at the moment in equities that I'm running are via vol. They're via being short vol, and I'm doing that via VXX broken wing put flies and put calendars on the VIX, basically.
Mm-hmm.
So those are structures that my subs know because they sit in my options portfolio that I share with my weekly subs. And the nice thing about those structures is that on that Monday where things were escalating in the Middle East and vol was popping and VIX went back to 20, I had those trades on and they weren't losing me much money at all, right? So they're comfortable shorts they're comfortable vol shorts because if the vol goes through 20 again or the vol just doesn't collapse, I'm not going to lose a lot of money on those trades.
Right.
It's not going to do me a lot of damage. But if the vol does collapse and we see VIX back sub 14, they're going to make a shitload of money. Right?
Yeah.
So I think that's the right expression where you don't have to commit to this big rally in stocks in the face of all the uncertainty that you've got around earnings, around geopolitics, etc., around yields. You've got so much uncertainty here. Just put a trade that will do well if vols reset. Vols will probably reset in some sort of rally. But then once you've had a little rally and vols have reset lower, that's when you then switch out of those short vol positions into long calls because you've now got confirmation that the market wants to rally. It starts breaking levels and the calls have just got a hell of a lot cheaper from a vol perspective. And you've made money on the way because you've been short vol via these vol trades, basically. So that's kind of how I'm positioning it and how I'm thinking about it.
I like that expression of the market rallying. I like that short vol trade. I also like that kind of long magnificent 7 if the balls kind of come in at all, or just sometimes again just owning the stock I think could be a little bit easier. Here's the kind of contango of the VIX term structure, which is interesting because this is a fairly sharp contango, and obviously we're going to settle tomorrow the front month future to the VIX index. So these are pretty well tied to each other. When you look at the S&P term structure, as you were mentioning the shifts of volatility, what's so interesting to me about this is that when you look out in time here, this is the S&P term structure. You have, I think, because of the Fed speakers and the litany of kind of things happening over the next couple of days, you have very, very short-term implied vol is quite elevated, right? But it's very flat structure, and we're only around 14, 15% implied vol in the S&P. This is obviously for the at the money. So, there is this backwardation, but it's not extreme backwardation. There's like this mild kind of anxiety. So the market doesn't really seem to be reacting from this perspective all that much to, the war situation or even the higher rates. Really, like we're not seeing a broader backwardation, I guess, is what I'm trying to get at, which I think is interesting. And I don't know if this is because so much, hedging and options order flow is now pulled forward and only takes place in the next few days or something. But you still kind of get this broad sense of, even though we have a lot of short-term anxiety, the market a month, two months out is just not really that worried about it.
Well, I think it's a function of two things. One is that the realized doesn't justify those vols going too backdated. And then also people are buying skew rather than buying outright vol. Do you know what I mean? So if you're worried about a war escalating and turning into World War III, you're generally just going to buy downside and sell upside, right? You're not necessarily going to buy loads of at the money vol. So that's why it makes sense that vols are not crazy elevated, but the skew is starting to get there. So last week, going into the weekend, you had 1 month $25 riskies at the 70th percentile in the S&P and NASDAQ, right? So that's pretty punchy. So that's really where you're seeing the risk premium in skew more than equity vol.
And if you, to your point here, if you look at the skew index, the SDEX, which measures, I believe, 5% out of the money at 1 month put versus the at the money, it did indeed pop on Friday, and that skew's really come off over the last kind of 2 days. It's still, quite a bit above where we were even just a few weeks ago. And this is that, I think, kind of that war premium combined with some of those higher rates. So nice observation on your behalf there, Imran, and I think it's true. And maybe if the conflict escalates, you see that skew pop again. Seems to be decompressing a little bit at the moment.
Mm-hmm.
Any thoughts, Imran, from U.S. dollars? You sit over there in London, so maybe you got some extra insights for us there. Not something.
Yeah, the dollar's an interesting one, right? Because you've got the idea that the Fed's done hiking now, and they've kind of started talking a little bit more friendly with regards to what long end yields have done, doing the work for them. So that, in theory, is dollar bearish. if that means if the market's repriced the idea that they're just not going to hike anymore. But you haven't really seen much of a move down in the dollar because you got the safe haven bid from the geopolitics, right? So if once this Middle East thing calms down, I think the dollar's getting sold, right? But it's just really hard to time that. So I do think that's why I've been sniffing around the idea of getting long some EM stuff like Mexico and stuff like that, because I do think when the dollar comes down, some of these EMs are primed to recover. So you had some really strong rallies out of Vietnam, Mexico. They're up 30% at one point this year, okay? And they've given back 20% from their highs nearly. And part of it is on this dollar strength and the unwinding of carry trades and things like that. Like dollar MEX was a massive carry trade. So I think if the dollar starts to come down into year end, you're going to get a bit of a bounce out of some of these EMs. So that's what I'm fishing for at the moment.
This happens to be Israel. It's just popped up, obviously, kind of a nasty couple of days there. Not going to make any comments on that one. This one I thought was interesting. Hong Kong. You can look back to recent lows. Obviously, a lot of headlines in China right now. You never know if it's an opportunity or not, but that's at major lows. Yeah. Fishing around here for Mexico. Forget the.
Again, it's one of those buying the strength in EM rather than the weakness, right? So China's been the weak one in EM, right? Whereas I'd rather favor the ones that have been stronger, like Brazil's been okay, Mexico's been okay.
Yeah, there's Mexico, Korea, Brazil. China really rather ugly there. Hero be used for indicating for day trades. Yes, we did a whole hero flow presentation as well behind our. If you go to SpotGamma.com, you can get a copy of that presentation where we outline how you can do that. I think we otherwise got to most of the questions here. Imran, any other thoughts here as we pull out of OPEX and we start to kind of wrap this up? I think we kind of checked off the boxes here in terms of the really tricky situation between VIX expiration today, Powell speaking tomorrow, the 17 plus Fed speakers, Netflix earnings, Tesla earnings tomorrow night. Any other things you want to throw onto that, before OPEX on Friday?
No, I mean, crypto is interesting. If you want to talk about crypto.
Yes, let's talk about crypto.
Crypto did some funny stuff yesterday.
Yes, it did.
It's you got a fake headline.
News headline.
You got a fake headline on social media from Cointelegraph saying that
that's this thing, right?
Yeah, that the ETF was approved, the BlackRock one, and we just ripped 12% in 5 minutes.
Yeah,
and then it got denied, and we came all the way back. So it's quite interesting. I mean, it triggered this big repricing of upside skew, as you'd expect. You got a load of liquidations of shorts, things like that. But it's just kind of. Every incremental thing like this that happens is just kind of getting the market more and more ready for the idea that the ETFs are coming, and that is potentially opening up the door to billions of dollars of inflows back into Bitcoin, which will have market impact, which probably then kickstarts the move towards 40K or something like that, right? So that seems to be the story that's playing out, but Bitcoin's very much in the driving seat relative to Ethereum. So like Bitcoin used to trade below Ethereum vol forever. And this year that is completely reversed on its head. And Ethereum trades 5 vols cheaper than Bitcoin, which is unheard of. But it's been consistently like that for months now because Ethereum's just a dog that can't rally, whereas Bitcoin's flying every time on the potential ETF news flow. So that's the world we're in crypto. It's quite an interesting one. But then the gamma's just been rubbish. Like it's been realizing 2025 and systematic gamma selling in crypto just keeps coming. So whereas crypto front end used to trade at 60 to 100 vol, it now trades at like 30 something. Right?
It's the maturity of the asset class, I suppose you could argue that, I guess.
Yeah.
Maybe it's the maturing of this as an asset class.
Yeah, I don't know if it's maturing because I'm not sure it's maturing. I think it's just the flows are quite overwhelming. So you had a DeFi market that was your yield hunting market, right? Anyone in crypto who wanted to earn yield would do it in DeFi. And then Luna happened, and then FTX happened, and everyone got blown to smithereens, right? So then the DeFi market just dropped off a cliff, and people still want yield. So now they're hunting yield by selling optionality. And, you know, the miners and the big call overwriters in crypto just keep selling Ethereum calls for fun. And that is basically that's putting pressure on the vol in crypto. And, you know, you still get 10% moves in 5 minutes, right? So it's just because the flow is just pushing that vol down. But sometimes these guys get hurt and you get these massive rips through their call strikes, and then they get forced to liquidate and cover and stuff. So
basically it's the same thing with SPX.
Huh?
Same thing with SPX.
Giant
fall sellers.
Yeah, exactly.
But I mean,
go on.
Even if that is the case, right? I think part of the knock on adopting Bitcoin is the volatility is so crazy that you couldn't really adopt it as, you know, as something more serious if you're a longer term holder, right? And so isn't that ultimately kind of a better for adoption if the vol comes down?
Yeah, it is. And also the correlation, right? If the correlation to TradFi drops and the vol drops, that makes it more appealing to every insto on the planet, basically.
Yeah.
So yeah.
And then there's the old school hedge, you know, gold, which is in blue here, which caught this big pop. Gold disappoints me every single time. Every time you go, this is finally it. It's going to, you know, triple. It just fades. And so, you know, it had this big kind of bid with the conflict, you know, escalation, and now it's kind of, I don't know. Doesn't seem really following through. It just doesn't feel that exciting. Any views on that gold?
Yeah, I mean, gold's a funny one. The vol went nuts on Friday. It has given a lot back. I think gold's one of those, but when it breaks the highs, when it actually breaks the highs, which are in the high 2000s, it's got the potential to rally 20% in a straight line, right? But, you know, there's just no point trying to preempt that, because it's just like
years trying.
it keeps disappointing. I mean, I don't mind. Vol got very cheap, so I bought some March next year calls a while back, and they were bleeding just like everything else. And then last Friday, they suddenly went back to what I paid for them just because the vol caught such a bid. So I probably should have sold them, to be fair, but I didn't, because I didn't buy that many of them. So I was like, I might as well keep them in the book. But they
who knows? Maybe in the Friday they catch another bid. And I mean, hopefully they don't. Hopefully that's not the case. But you never know these days.
Exactly. I want to lose that premium. Yeah, it's true.
Yeah. All right, Imran. I think we're approaching the top of the hour here. I did want to bring up again the hedge at the top left of your screen here, or top right, whichever one. There's a QR code for the hedge. And Imran has been gracious enough to professor, can I say that? Teach, educate a SpotGamma course where we take you all the way through what is an option, all the way up into kind of some of dealer hedging, hedging portfolios and different things like that. So please check that out at academy.spotgamma.com. Imran, how can people find you and get some more of your excellent work?
So I'm on Twitter on options_insight. Put loads of stuff on there. You can get a sample of some of our content on there. And then we've also got, obviously, our website, options-insight.com. And there you can see what our services are. We have daily products, weekly products on crypto and macro. And little exclusive, I'm working on a potential crypto podcast. Weekly crypto options podcast that I may be doing in the future. So look out for that. It's not confirmed yet. So
busy man, Imran.
Huh?
So you're a busy man.
Busy man.
Two quick notes here. Contango, whoever you may be there in the comment section, I see your chat there. You're not invisible. We will have support respond to you post haste. And then Chris just asked a quick question about one-day implied move. That's measured from the day's open. So we offer this implied move. You measure from the open of the SPX and then to the close. So I think today we're about 75 basis points. So note that. Anyways, sorry for that segue. You can find me at SpotGamma on Twitter. Also note that Imran and I have started to do a Monday morning meeting, which is a little more single stock focused. Some people like that. Some people only want us to talk about macro. Some of people will say we don't want to hear anything out of your mouth, but we run the Monday morning meetings anyways, right? So start looking for that. That's a recording that we put out every Monday morning meeting. Again, it's a little more single stock focused, where Imran and I both just kind of pitch an idea on whatever may be interesting. So please check that out. And I guess Imran will be seeing you on Monday.
Yeah, exactly. See, I get to chat to you every week now. It's great.
It's very exciting. Yeah. I love it.